Okay, I think I'll kick it off then. Welcome everyone to this webinar brought to you by CYBERA. This is the first of hopefully many CYBERA talks that we will organize on the topics of fighting scams and fraud. Today's topic and what we're talking about is what steps are regulators around the world taking when it comes to scams. I'll be leading this conversation here today together with our head of product, Rob, who joined us today. A quick intro on the format of the webinar. I'll start off with a short introduction on CYBERA, basically telling our story, why it is what we do, followed then by a Q&A format between myself and Rob on the recent developments and regulations around the topic of scams. In terms of housekeeping, to inform you, the session will be recorded and we will be making a link available after the session for you to view it. Please, we urge, if you have any questions on the topic, use the chat function here within Zoom. And if time allows at the end, we'll address them or follow up with some answers after the webinar. So as I said at the beginning, welcome again to this webinar. My name is Claudio. I'm one of the co-founders at CYBERA. Today, we're a global company working together with financial institutions, crypto businesses, and law enforcement, fighting financial crime. But it all started 3 years ago when I, together with Nicola, as you can see, my brother, started CYBERA. And what we do today very much goes back to his background, working for several years in law enforcement as a public prosecutor specialized in fighting financial crime. And in that role, he experienced some frustration, mainly with regards to the increasing amount of scam victims coming his way. He wasn't able to help most of these victims, when they lost funds based on a scam. And so that frustration is what turned us to look at the problem and say, we can make a difference here by adding innovation and technology to better support victims of scams and to allow for sharing information, ultimately to make a difference in preventing scams as well in the first place. So that bit to how it all started, quickly handing it over for an introduction to our head of product, Rob here.
Thanks, Claudio. Yeah, so hi everyone, Rob Tharle, head of product at CYBERA, and I've been in the fraud prevention space for the best part of 20 years in UK retail banks and some large vendors, and really seen the shift over that time from away from the traditional unauthorized fraud into authorized fraud and scams, and how that's actually rising globally. It's not a UK specific issue, but the UK's got some really good numbers, so we'll spend a bit of time on those, right across all jurisdictions, and not just at the harm they're causing, but I've, before being at CYBERA, I've helped prevent and detect these types of fraud and protect customers, and that's what we're here to show, how we can keep needing to do that today.
Great, thanks, Rob. And so set the scene a bit. If you look at losses deriving from financial crime, then the largest amount is associated actually to scams and frauds, to the use case of social engineering, even above ransomware, for example. And so scams really are a growing threat. As we mentioned here, time to act is now. The numbers that support that, you can see here on the slide, are shocking to say the least. In the US, we've seen over 10 billion in damages last year, 3 billion alone from investment scams. and similar numbers, equally impressive given the size of the countries, of about $500 million in damages, across in the UK, Australia, and Singapore. And needless to say that we expect these numbers, unfortunately, to go further up in the near future as our world becomes more digital, and a lot more things are happening, so to speak, behind the screen. So these numbers have led to governments and regulators around the world, having to have a closer look at the problem and basically react to protect the end customer here. So on a high level, and we'll go into details here with Rob, but on a high level, the UK is the first country to really take concrete action and put into law a liability shift towards financial institutions having to reimburse victims of scams. That's first of its kind in that sense, and we see other countries following that example, looking to the UK, like Netherlands or Australia, and even in the US, we see some shifts or conversations around shifts of liability more towards the financial institutions when we talk about scams and authorized fraud. So take a step back and on a high level, Rob, why are authorized fraud and scams such a big problem in the first place?
Yeah, thanks, Claudio. But obviously, you've introduced some of the numbers, which clearly, try and make something tangible there. And they are big. The UK one actually did drop last year, but that's partly because it is taking action and bringing on incentives, which we'll touch on later. And this is obviously just a few areas. There's no robust EU numbers, so we haven't got Europe there, which would be chunky as well, amongst other parts of the world. But it's much more than those losses that the issue. So, in the majority of countries still at the moment that haven't, unlike the UK, that haven't put in regulations about refunds, that means that those customers they lose their money. And most of the scams, or aside from purchase scams, like things like investment scams and romance scams, they're really big sums. It's not like €1,000 or pounds on a debit or credit card. It's probably their life savings, and for businesses it might be CEO frauds, BC frauds. Then again, they can actually bring those businesses down. So these are some real big implications for the end users here, that I think often gets dropped in some of the discussions about fraud more generally. And then you can move on to things like, well, most jurisdictions are now either got real-time payments or got big programs to put real-time payment systems in. Yeah, at the same time, and digital payments more generally, but at the same time, we've then got these sorts of things that have so distrust in that, and there are wider benefits from those systems that can happen. So if you end up having big swathes of people that perhaps end up with higher cost payment systems because they don't trust using low-cost digital payments as well, and that's a big issue if you've just spent several billion pounds or euros or dollars implementing real-time payment systems. So FPS in the UK, we've got SEPA Instant in Europe. Fed now is just about to launch, as well as RTP in the US, for example, Switzerland 2024. So there's a lot happening in that space. But then for the banks themselves and the credit unions, there's the operational impacts for them. So even if they don't have liability, they still have to deal with all of those downsides. So the customers still phone them up or submit complaints, whatever. They've got to spend time chasing funds. They've got to spend time, dealing with that customer, and they're quite hard ones to do. And you also end up potentially with some credit losses if your customer owes you a lot of money, especially on the business side, and now their business is essentially gone because they've lost most of their working capital. Then you have those sorts of impacts as well. So there's often for banks something they need to do, and I'll touch on a little bit more. And then probably one of the most important is the money goes to the bad guys, right? So, and they do not do nice things with it. They're not just buying a Lamborghini and having a nice time. A lot of this is then used for further crimes, including human trafficking, and actually, there's a lot of evidence that big chunks of the fraud and scams are out of essentially human slavery in places like Cambodia, where people have been trafficked and forced to do this. So, and more money that goes through it, the more that gets perpetuated. So we do need to think about that in there as well.
Yeah, no, that's very insightful, and really like the what we just said in the end, that the dimensions here, they go far beyond just, I mean, not just, but one person losing money could be their life saving, but it goes much further. This money is being used for you obviously as part of money laundering, for human trafficking and other severe crimes down the road, especially not only fiat, but what we see as well at CYBERA, a lot of crypto transactions involved in these kind of criminal activities. So you set the scene, you kind of showed the impact here on the consumer, but as well on the banks. Given though the assumption that the user or the consumer is responsible for the payments they make, right? Which is the case in most jurisdictions today. Why still do banks and payment firms need to care? You touched upon it a bit, but maybe you can elaborate there.
Well, certainly you've got the operational impacts I touched on. But I think one of the biggest things then is the customer experience impacts as well. So you've got the negative experiences for the victims, but you've also got, on the flip side, if you're not doing your fraud prevention correctly and not really concentrating on the authorised frauds properly because you don't carry liability for them necessarily, then you also end up with impacts on it. Maybe you do blunter things to try and stop them, so you decreasing payment limits or blocking certain types of payments or things. So you have some poor customer experiences there if you don't do it properly. So the flip of that is, if you look at it more holistically, you make sure that your fraud prevention engines can do everything, you get the right data points in, then you end up with good prevention, which leads to better net promoter scores, and you can end up with victims actually being, or victims where you've maybe stopped, you've let the first investment fraud scam go through for them, but then multi-payment ones, you stop the others. They can end up being advocates if it's done well and you've got these, put the investment in right. And clearly doing that fraud prevention activity up front, we'll come on to some of the sorts of things later, but then that lessens that operational impact as well. So you end up with lower costs, because the prevention is much easier to deal with the preventions than it is to deal with all the fraud efforts. Because again, coming back to that impact on the customer, these are not short conversations. It's not press a few buttons, say sign a declaration for a chargeback, and off we go. They're on the phone for a long time, and they're also with the conversations that it's very hard to then automate in some fashion, whether it's through chatbots or otherwise. For that very reason, you can automate some of the others a bit easier. So there's a whole range of reasons why. And then of course the big one is, everyone's watching the UK, which I'll touch on soon. The regulators are coming in some format or other. We have already seen, even in the US, where the CFPB, they've not reinterpreted, but they've put some clear guidance in there about the Reg E, that it largely covers unauthorised payments, about when that covers them for some authorised. So if you give your password away and things like that, that they're still covered. So and clearly the Senator Warren is doing a lot of work there to try and influence things around Zelle and what have you. So I think that liability in some formats is coming to all jurisdictions. It's just when, not if. Yeah,
absolutely. And we've mentioned it a couple of times now. The UK here is leading the example. It's been controversial, I would say, discussed on what they're doing. So I think it's great, Rob, if you can flesh out a bit kind of what exactly is the UK is doing, and maybe what some of the consequences are for that.
Yeah, sure. So the UK's had some form of reimbursement strategy, the contingent reimbursement model, since sort of mid 2019. The UK sort of was the first country, certainly the first large developed country to have real-time payments. So they've had it for 15, 16 years now. And the two tend to go together. The faster the payments, the easier it is to do these things and move the money. So what we've now ended up with, it's not live yet, but it's very clear that it's going live in sort of Q1, Q2 next year, is 100% refund for victims. So there's some small print around that. So it's retail consumers, and small charities, some SMEs under $1 million or 2 million, I think, something along those lines. But 100% refund rate within 5 days. So there's a few exemptions to that, which I'll come on to, but by and large, that's the policy. And then that is going to be shared 50-50 with the beneficiary bank. So suddenly, and the rationale for that, just quickly, is about aligning incentives. None of these sorts of frauds and some of the unauthorized frauds can't happen in push payments without an account, a mule account, or multiple mule or drop accounts, as the US called, from being in place. So all this time, and the AML legislation has largely meant that banks try and say, well, we've done a SAR, we don't get fined, everyone's happy. But clearly the numbers you've shown, that's the money that's flowing through, and it's an awful lot. So putting some liability on the paying bank is key. So I said there's a few exemptions. So there is going to be a small excess applied. Not sure how big that is. It will be fairly small, so the customer might have to pay £50 or something, and that will be it. There will be a maximum value that hasn't been defined yet. I suspect it will be set in such a way that the vast majority of customers get all of their money minus this little excess. So I would imagine it will still be quite a large number. A lot of the things that went into the consultation were, well, if you bank with a bank, if the bank goes bust, you only get, in the UK, you get £85,000 back. So, so maybe we'll see something in that sort of space as a max value. It's only covering the faster payment system, so there won't be any crypto in there if it goes up to there. No international payments.
Right.
There's some nuances. We've got a couple of other systems in the UK, so chaps should be covered by an equivalent thing from the Bank of England, and on-us payments. So if it goes from your account at one bank to a fraudster's account at the same bank, hopefully should be covered by the FCA, but it's not covered under this regulation. Will exclude gross negligence, but that should be very high level. Vulnerable customers, gross negligence doesn't apply. And then we get into some fairly obvious ones to some extent. If there's evidence of the first party involvement, the customer's has been involved with the fraudster, then that won't be paid. If the payment itself was for something that's unlawful, then that won't be paid. And it doesn't include disputes. And then the last sort of one is really just if it's over 13 months old, it's not covered, or indeed prior to this becoming into full force as well. So, it's quite, whilst there's a few exemptions there, at the moment of 85% of all the push payment frauds in the UK are via fast payments. So actually it still captures nearly all of this, right? So at the moment, but it does leave things open for shifting of pieces. And then, so just quickly, what does that mean for banks and PSPs at a very high level? They're really going to have to up their investment across a whole range of pieces. So inbound payments as well, getting the dynamic messaging right to try and protect customers, and trying to stop mules right throughout the customer life cycle. So onboarding, ongoing, and then obviously improve recovery as well. So a whole range of things there. So it's quite big.
So yeah, so very interesting developments on that front. And you just mentioned it, that will mean for banks, payment firms to do quite some investments on that front in probably tools and solutions, helping them to, reduce the impact of scams. How would you respond to that, resulting in increasing costs then, basically that are being passed on to the customers? Is obviously that's a problem. That's a realistic thing to happen, right? But curious to get your input on that.
Yeah, I think the key thing, and I did mention it before, is it's about aligning incentives. So, is it necessarily fair that banks pick up all the tab? Possibly not, but they're in a better position to do something about it than the man in the street. But there's other players which I'll come on to as well, that perhaps in some point might need to be funding some of this. And I think if we see that when we see banks have the incentive for fraud, whether unauthorized fraud or for authorized fraud like this, and especially on the paying bank, they've put more controls in. Arguably, the controls that banks put in for unauthorized fraud is partly why it moved to authorized fraud, right?
Yeah.
There wasn't equivalent controls there. And so you then see that on the paying bank, the beneficiary bank too. And the combination of that then actually should, over time, bring that down, the whole level down and the attack level down, because it's harder to get away with it. And so, versus the argument that says, well, customers just won't pay any attention anymore. And I think, again, like I mentioned earlier, these are life-changing sums, and people do pay attention. It's just they get scared into it in many instances. As I mentioned, the UK's had some form of reimbursement for authorised frauds for the last sort of middle of the year for 4 years now, actually. And so there's no real evidence of moral hazard there. What we've seen is fraudsters continue to get money and continue to come up with different ways of getting that out of people. And we're now at the point where the vast majority of people fall for it. It's the biggest type of crime in the UK. It's about 40% of all crime. So I think that's not really there. We need to stop the criminals getting the money. And then there's other players, and the UK banks put out some numbers this year for the first time for the 2022 numbers. 76% of all the cases came from with online is some form of the starting point. Telcos made up another 18 and email 2%. But if you look at the values, that switched around, and it's actually the 36, 44 and 12 respectively. So email's sort of disproportionate there in terms of value versus volume. So we've got this situation where we've got lots of players in that space who all make a lot of money out of the advertising that goes alongside some of these scams in some fashion or other, but aren't paying. So I think there's other opportunities to rejig that. And we just have to decide really as a society to some extent, which the UK has essentially done, about how to internalize those external costs, and that's going on. If that gets spread out across the entire population for the slightly higher banking costs versus individuals being slightly better off, and that seems to be the decision that's been made there. I think in reality it won't be quite as bad as that, because the overall numbers should start to come down if the investment is made.
Interesting. And I like what you said about the shift of basically the crime. So as banks became more sophisticated to protect themselves from unauthorized fraud, it went to authorized fraud. And I could see a similar development now that the UK will be implementing that reimbursement model within the UK. That most likely will see a shift of fraud or scams going to other countries, likely. Basically sending money abroad. So yeah, definitely interesting to watch what's happening on that front after that regulation is coming into effect. In terms of the example of what the UK is doing and kind of being ahead when it comes to this shift of liability, can you give us a quick insight on other countries, how they are responding to this new regulation or to this development? Especially kind of if you look at the Asia and the Americas.
Yeah, sure. So, and I think it's really started to gain some momentum now in the last 12, even the last 6 months or so. So, we've seen announcements in the last few weeks from Australia where they're looking at having a cross-industry liability model in some format or other. That's actually looking at, like I mentioned before, about trying to maybe go slightly further than just the financial institutions that are involved to, some of the big tech platforms that kick off some of these schemes, as well as a data sharing initiative as well to try and help stop more there. So there's some elements happening there on top of things like trying to limit how telcos are abused in terms of SMS scams and spoofing numbers and things like that. So we've got that sort of down in Australia that seems to be heading in a similar-ish trajectory. If we look at, the Monetary Authority of Singapore, they've put an awful lot of effort into things. You're not allowed to send links in SMSs and emails, for example. They're very much looking at the UK position, and they've got some high expectations on their banks for refunding customers. And if banks aren't doing enough, they slap them with higher regulatory capital as well, operational risk capital as well requirements if they're not doing enough in that space. And that can be, significant sums for organisations if you start talking about the impact on sheet. Then we haven't talked yet about, I guess, the two big beasts there of the US and the EU. So in the US, as I mentioned, we've seen some developments on Reg E that takes out certain elements, and the pressure from Senator Warren and others. That pressure has actually led to Zelle, which I guess is one of the biggest types of fraud from a payment system point of view in the US, with person-to-person payments. They've proposed and are implementing their own a refund model that again looks to put liability onto the beneficiary bank, either in full or in part. So even in the US, that's starting to happen. And then more interestingly, in the US, last month there was a federal court judgment that did find that a credit union was liable for another bank's customer's BEC fraud as the beneficiary, which was really about not having the right fraud controls in place that were reasonable and taking enough care, and that led them to have that liability. They lost that, and that's in a federal court. So depending on the appeal process, that could well set a precedent there. So it won't mean they'll necessarily be liable all the time, but if you haven't put enough effort in, then that's when your liability will start to kick in. And then very final point here, that just today, the EU, as part of a wide-ranging set of announcements, the Payment Services Regulation, or PSD3, is going to have some authorised fraud liability. They haven't really gone into any detail on that yet, but that will be forcing banks to do a number of things, including a name checking service like the UK's confirmation of payee, among other things. So to say that, I think the momentum is clearly there. The UK is just already on that, so it's going to happen. You need to be ready.
Very interesting. Thanks for sharing all that. So certainly a lot of movement happening in several jurisdictions, and definitely wouldn't be surprised to see other countries follow these examples. Whether it will be as kind of a clear path as the UK or more of a mix is still to be seen. What does that mean, though, then, on the level of financial institutions? So for banks and payment companies, what effect or what consequences it really have, this change in liability or shift in liability and regulations coming up?
Yeah, I've touched on some of this already, but the increased liability, somewhere like the UK, that's going to move, put about another 250 million pounds of liability onto banks, and then redistribute that between paying and beneficiary banks around. So for some organisations, maybe some of the neobanks that predominantly are the recipients of that will and don't actually pay much out, that potentially has some quite significant impacts on their business and their profitability, assuming they're even profitable already. It's sort of tens of millions potentially. So what that means is, for all organisations, it does create that very clear business case to invest in tools that will help them achieve those aims that we talked about through. And say it's not just about outbound payments, but real-time inbound payment profiling, and then looking at real right across the piece. So right from account opening and KYC, their ongoing due diligence, as well as stopping those payments actually walking out the door by making sure they're not paying to known mule accounts and things like that. And they'll also have to change how they do their suspicious activity reports and indeed DAML-SAR, so the defence cases there, if they are still going to pay in a way. More operational resources and automations required to keep that to a sensible level, and then it's going to, if you're already in a jurisdiction that's got real-time payments or real-time payments coming in, that exacerbates it, and you need to do more.
Yeah.
You've got FedNow coming in next month. RTR in Canada's has been delayed for a bit longer, so there's probably another year away. SEPA instant expansion that is out but is not well used, so but the EU is really pushing that, so that's going to happen. And then Switzerland's got it as well next summer. So all those areas, it's a double whammy if you're not used to real-time payments. If it's new, it makes it it can shoot up very fast, and so lots to do for everyone globally, I think.
Thanks. And building on that, what do banks and credit unions need to do, or what can they do kind of right now, right, to in terms of action items to reduce the impact on their customers and ultimately themselves? Are there a few kind of tips or insights you can share here on concrete action points that are helpful?
Yeah, if I just drill down into sort of some of the points I just made a bit further. So, I mean, the first point is we can't educate our way out of this. Right? Customers are still going to fall for it. We need to do education. It needs to be part of a wider national and international piece of action, but that isn't going to solve any of this. What will help, though, is that the beneficiary banks, the PSPs, the crypto exchanges do more to stop the mule accounts in the first place. So, those investments should therefore cover things like utilising lists of known fraudulent accounts, whether that's account numbers and sort codes, IBANs, wallet addresses, but also the PII that goes along with those. So the names, dates of birth, etc., emails particularly, and other aliases like phone numbers as well. So stop them getting in right at the start. Certainly make it harder for organised crime. I think this is a point that's often forgotten. The level of effort that the criminals put in is in direct proportion to the amount of controls that the banks or PSPs or crypto firms have. If they make it easy, they don't have to put much effort in. They do reuse all this stuff because lots of places don't actually check it. So it sounds silly. Some sort of go, well, they'll have stopped using it. They'll use something else. They don't if they don't need to. So that will really help. Enriching the transaction monitoring systems, again, with lists of known details and networks and beneficiary names, the account aliases particularly there, and that works in a few ways. Improved network analysis for looking for linkages and be able to create networks of good sets of customers and bad sets of customers to further improve detection. But it also helps, again, stop that money walking out the door. And on the inbound side, you can actually then stop that onward transmission of funds. It might not be your customer. You go, well, why has my account got money from that mule? Because a lot of the time, we haven't touched on it today yet, but these are multi-generational cash out schemes and money laundering. So the victim goes to one or two mule accounts, and then it will go from there to So UK did some work a few years ago, and it was, I think, averaged about 6 hops before it was sort of finally cashed out. So there's other opportunities there to stop it. Ensuring victims can actually quickly and easily report frauds and scams is also key. The UK's got good numbers, partly because it's got good reporting systems, but making tell customers they can report it, get it reported properly, get that intelligence into law enforcement in the right way as well, so that they can take action and do the disruption activity that again really helps in this space too. And then in terms of the banks themselves, working alerts, trying to make sure they get as much intelligence about potential mules on their books as well as quickly as possible, then repatriating those funds that they've stopped. I think, and as I mentioned earlier, some automation is really key just to free up resources, because if you don't automate, this can be quite deeply in if we're not careful. But all of that should end up meaning that we end up with reducing the level of frauds, generally increasing recoveries, and therefore then that reduces that new increased liability for PSPs down to something more manageable.
No, great. I think this is very helpful advice, for everyone listening in here. Is there any final or further thoughts, next to kind of the expertise you shared with us already on the topic, as we kind of come to an end of the webinar?
Yeah, just a few things. I think, we've concentrated a lot on banks. I've touched on other parts of maybe the overall fraud chain. It's not just banks that need to put more resources in and have better incentives. It's law enforcement agencies, again, need those resources and to do some of the similar things, or be able to utilize the intelligence that we just talked about. I think big tech and other platforms, they need to do better, taking the ads down, stopping the ads, fake ads getting up there, taking down the fraudulent social media profiles, the fake websites, etc. That all the dodgy looking job scams that all contribute to that whole piece. And again, many of the things that I've said, okay, they might need adapting in some way, but can all be utilized by those sorts of providers too. And I think it's likely that they need to be incentivized in some way. I mean, the UK's new law on that will come in soon on failure to prevent fraud could potentially touch on some of those if they're actively, you don't put enough controls in to stop profiting from fake ads. That's one potential there, certainly for those large ones. I think that more resources are needed to throw at this problem. It's organised crime, it's global, and there's the amount of money involved. So bit of incentivization, and those funds can be and resources can be better redistributed.
Great, Rob. Thank you very much for sharing all your expertise on this topic. A lot of things happening, and we'll definitely keep observing closely what the developments are and follow up on a regular basis on what's happening in the space and some of the consequences from these new regulations. So very briefly, how CYBERA fits in here in these topics. We've built a platform over the last 3 years that really tackles this problem from 2 angles. One of our solutions helps on the response side of things. So basically, we built a process where we work together with financial institutions and crypto businesses and law enforcement to provide the best possible support for scam victims out there, allowing them to record or report a case online, where we guide them through the process, help file with law enforcement globally, and trigger a global response process, based on Interpol recommendations, really making sure that the case is being communicated in the fast possible manner to the right stakeholders, always with the goal, first of all, to provide a better customer experience. We haven't touched upon that element too much today, but Rob mentioned it. A lot of customers lose their life savings. It's a very bad experience. We really want to make sure they are guided through the process when this happens. So that's the response side of things, where CYBERA is active, supporting banks and payment service providers. And then as a consequence of that, as we support victims on a global scale, we gather a lot of relevant intelligence that can be used effectively on the prevention side of things. So every day we collect intelligence on mule accounts in the traditional sector, but as well crypto wallets that have been used in connection with financial crime, and we provide access to such a high quality curated list of financial crime data points utilized in your fraud prevention efforts as part of transaction monitoring or as part of some of the action items you can do that Rob mentioned earlier, such as inbound or outbound payment profiling, to really make sure you protect your customers and your institutions from such increasing level of scams and unauthorized fraud. We of course encourage everyone who's listening in, to start a dialogue with us. There are several ways of how you can partner with us, kind of join our community, because one thing is clear: the fight against scams and fraud, it cannot be one alone or in solitude. It needs a network. It needs collaboration across industries, across stakeholders. We actively work with the traditional financial sector, with the crypto sector, but equally with leading nonprofits and law enforcement globally to really make a difference here. One for customers, but as well for all these different institutions when it comes to fighting scams. So with that, I want to thank everyone for listening in, being part of this webinar. CYBERA Talks will be doing regularly such webinars on topics that are being discussed currently. If you have any questions now or later, feel free to ask them, but generally, thank you everyone for joining today's session. I'm just checking in on a potential question. So Rob, there has been one ask. If you can quickly elaborate on that, on kind of just getting, I think, the insight here on how this affects the crypto sector. I mean, that's a broad question, but maybe you can give one or two examples of, how that impacts the crypto space.
Yeah, so I think there's a couple of points I'd make there. So UK, US, amongst other places, we've seen quite a lot of debanking, essentially, of crypto institutions and exchanges, as the banks don't want to touch them because of the level of fraud associated with certain elements of that place, and that's having a negative impact on the entire sort of digital assets area, rather than, say, exchanges that just do sell Bitcoin or allow investment in Bitcoin. So that really sort of, that whole piece, again, I mentioned about trusting digital payments earlier, and that goes for crypto as well. If you want that to be mainstream, you want to build this proper legitimate businesses, then need to be doing something about that and not allowing it to be completely the Wild West. And then I think more sort of impactful will actually be in the sort of short term is the increasing regulation that's happening. Whether it's MiCA in the EU, the various things that are coming in on the back of the consultations that the UK have been doing recently. See, the US, the SEC are doing an awful lot. They even shut a number of those businesses entirely, but the increasing regulation is likely. The UK one specifically was about trying to have equivalent regulations for equivalent risk, not necessarily the same, but the outcomes would be broadly similar. So you certainly get to a point that at some point in time, then you'd expect similar things to be foisted upon those exchanges as well, and not least the things in making sure they've got the right AML process, KYC processes. Because if you're, if the banking system's doing their bit and starts shutting that down, but it just migrates to the crypto, then you don't have to be a genius to see where I think that will go.
Yeah. Great, thank you, Rob. And with that, I don't see any further questions at this point. So, we'll wrap it up here. I wanna express my thanks to Rob for sharing your knowledge and expertise. here today. Very interesting topic that we keep following and updating our community. Thanks everyone for joining this webinar, and hope to see you very soon at the next webinar or in one of our conversations. Have a good rest of the day.